What I'm about to share with you, I've gone back and forth for months about whether I should say this out loud, because once you see it, you can't unsee it. And once you understand it, there's no going back to pretending everything is fine. In my 40 years in finance, I've lived through crashes, bubbles, panics, recoveries. I thought I had seen it all. But I want to be very clear with you right now. I have never been more concerned than I am today. Not in 2000, not in 2008, not even in the depths of the financial crisis. What's happening now is different, quieter, slower, and far more dangerous. For people who aren't paying attention, let me tell you something most people don't understand. The biggest financial disasters don't arrive with sirens. They don't announce themselves on the evening news. They build silently while people are distracted, tired, and convinced that things will work out like they always do. And by the time the headlines catch up, the damage is already done. When I sit in rooms with billionaires, here's what they talk about. Not returns, not flashy stocks, not headlines. They talk about risk, about fragility, about what breaks next. And recently, those conversations have taken a very dark turn. The wealthy are quietly moving their money, repositioning, preparing. And most people have absolutely no idea why. The media won't tell you this, but confidence is disappearing behind closed doors. Not panic yet. Something colder than panic. Calculation. Because the people with the best data, the longest memories, and the most to lose are acting very differently than they did even a few years ago. And whenever that happens, history tells us one thing. Ordinary people pay the price. I remember back in 2007, sitting across the table from senior executives who were smiling in public and sweating in private. On television, everything was contained. Privately, we were asking a very different question. How bad could this really get? Most people didn't ask that question until it was too late. And today, I'm hearing that same tone again, calm voices, serious eyes, long pauses. What I'm about to tell you, I probably shouldn't be saying this publicly, but if I don't say it now, I'll regret it later. Because the warning signs are no longer subtle. They're just inconvenient. And inconvenient truths are the ones people ignore the longest. Think about this for a moment. Wages feel tight, even when you're working harder than ever. Debt feels normal, almost unavoidable. Asset prices look strong on the surface, yet people feel poorer, not richer. Does that make sense to you? Or does it feel like something is off, but no one can quite explain why? Here's what the wealthy do that the middle class doesn't. They don't wait for confirmation. They don't wait for the government to admit there's a problem. They don't wait for markets to crash to prove them right. They move early, quietly, and decisively. And right now, that movement is accelerating. Most people make this critical mistake. They believe the system is designed to protect them. I want you to listen carefully when I say this. The system is designed to survive, not to save you. It will protect institutions before individuals, balance sheets before households, stability before fairness. That's not evil. That's how systems behave under stress. I've seen this pattern before, and it never ends well for people who are unprepared. First comes denial, then confusion, then anger, and finally, acceptance. By the time acceptance arrives, the opportunity to act is gone. What's terrifying isn't that something may break, it's that people assume nothing will. That faith alone will carry them through, that tomorrow will look like yesterday. But markets don't move on faith, they move on math. And the math right now is unforgiving. Ask yourself this. If everything is truly fine, why are central banks trapped? Why does every solution seem to create a new problem? Why does growth feel artificial, propped up, dependent on constant intervention? And why does it feel like the margin for error is shrinking every single year? What I'm about to share could change your financial future, but only if you're willing to hear it without comfort, without bias, without fear. Because the truth doesn't care if it scares you. It only cares whether you act on it. This isn't about predicting the exact day something happens. That's a fool's game. This is about recognizing direction, momentum, pressure building beneath the surface. And right now, pressure is everywhere. In governments, in households, in markets, in psychology. If you remember nothing else from this video, remember this. Risk doesn't disappear, it hides. And when it reappears, it does so violently. I know this sounds heavy. It's meant to. Because pretending otherwise would be irresponsible. And I'm speaking to you now because I believe ordinary people deserve the same clarity that insiders quietly share with one another. If this conversation matters to you, if you want to understand what's really happening before the headlines force everyone to pay attention, stay with this channel. Not for hype, not for fear. Hodenider 2000 and Efri family 2000, but for clarity, because clarity right now is the most valuable asset you can have. And here's the uncomfortable truth. What comes next will separate those who react from those who are ready, those who hope from those who prepare, those who trust the narrative, and those who read between the lines. Because the question isn't if the world is changing, it's whether you'll understand how before it's too late. I've been in this business for over 40 years, and I don't say what I just said lightly. So let me slow this down for a moment and tell you why times you should even consider listening to me. My name is Larry Fink. I started my career when markets were still traded by hand, when information moved slowly, and when mistakes were paid for immediately. I've lived through inflation in the 1970s, the crash of '87, the savings and loan crisis, the dot-com bubble, the global financial crisis, and everything that followed. Each cycle looked different on the surface. But underneath, the patterns were eerily familiar. Today, I lead BlackRock, the world's largest asset management firm, overseeing more than $10 trillion on behalf of pension funds, governments, institutions, and ordinary people saving for retirement. That number isn't meant to impress you. It's meant to give you context. When you sit at the center of that much capital, you see the world differently. You don't get the luxury of optimism without evidence. When I sit in rooms with world leaders, central bank governors, and CEOs of the largest institutions on earth, the conversations are not emotional. They're clinical. They're about trade-offs, about what can be saved and what might have to be sacrificed. And I want you to understand something clearly. Asterisk, asterisk. The discussions happening in private are very different from the reassurance offered in public. Asterisk, asterisk. I remember back early in my career, in the late 1972, making a painful mistake with interest rate risk. It nearly ended everything for me. I lost money. I lost credibility. And I learned a lesson that has stayed with me ever since. Markets don't forgive ignorance, and they don't reward wishful thinking. That failure forced me to obsess over risk, not returns. Risk. That obsession is why BlackRock exists. It's why institutions trust us in moments of stress, and it's why I feel a responsibility to speak now. Because silence at this moment would be easier, but it would also be cowardly. People assume that those at the top always know exactly what will happen. That's not true. What we do know is asterisk, asterisk, when the margin for error disappears, asterisk, asterisk. And right now, that margin is thinner than I've ever seen it. Here's the part that may surprise you. I'm not sharing this because I think people are weak. I'm sharing it because I think people are being kept in the dark. The average worker, the small investor, the young professional trying to build a future, they are told to stay calm, stay invested, trust the process. But rarely are they told what the process times actually looks like under stress. Let me tell you something most people don't understand. The global financial system is more interconnected than ever, but also more fragile. Speed has replaced resilience. Complexity has replaced transparency, and leverage has replaced patience. Those things work beautifully in good times and catastrophically in bad ones. I've watched governments grow more dependent on debt, corporations more dependent on cheap money, households more dependent on credit just to maintain their standard of living. Each step felt reasonable in isolation. Together, they've created a structure that requires constant support just to stand upright. And here's why I'm choosing to speak publicly now. Because the people who will be hurt first are not the people making the decisions. They never are. They're the ones who trusted the system to be stable, who assumed someone smarter, somewhere higher up, had it under control. I've sat across from policymakers who genuinely mean well and are still trapped by the consequences of past choices. Once debt reaches a certain level, your options disappear. You can raise rates and risk collapse, or keep them low and fuel distortions. That's not theory, that's the reality we're living in. You might be asking yourself, if things are so fragile, why do markets still look strong? Why don't things feel like a crisis yet? And that's an important question, because the most dangerous phase is not panic, it's complacency. In 2006 and early 2007, markets were calm, volatility was low, confidence was high, and behind the scenes, risk was piling up like dry timber in a forest. Today feels uncomfortably similar, except the scale is larger, the tools are fewer, and the consequences would be broader. I'm not here to scare you for the sake of fear. Fear without direction is useless. I'm here to give you perspective, because perspective is what allows you to act times before times pressure turns into pain. Most people think credibility comes from certainty. It doesn't. It comes from humility, from knowing what you don't control. And I don't control markets. I don't control governments. What I control is whether I tell you the truth as I see it. And the truth is this: the world is entering a period where old assumptions no longer hold, where the playbook that worked for decades is being rewritten in real time. And those who rely on autopilot are going to struggle. I'm speaking to you not as a CEO, but as someone who has seen how quickly confidence can evaporate, how fast liquidity can vanish, how narratives can flip overnight, and how unprepared most people are when that happens. What comes next in this conversation is not comfortable, but it is necessary. Because now that you understand times why times I'm speaking, it's time to talk about times what times is actually happening beneath the surface. The mechanics, the pressures, the signals most people are missing. And once you see those clearly, you'll understand why I opened this video the way I did. Now let's talk about what's actually happening, not the headlines, not the talking points, but the mechanics underneath the system. Because once you understand the mechanics, the fear you feel won't be emotional anymore. It will be rational. Here's the problem in simple terms. We built an entire global economy on cheap money, and now cheap money is gone. Or at least, it's no longer reliable. For more than a decade, interest rates stayed near zero. That wasn't normal. That was emergency policy turned into everyday life. Governments borrowed like rates would never rise. Corporations took on debt because it was easier than discipline. Asset prices inflated because money had nowhere else to go. And households slowly adapted to a world where debt replaced income growth. It felt good until it didn't. Let me tell you something most people don't understand. When rates rise, they don't just affect new loans. They reprice the entire system. Old assumptions break. Balance sheets weaken. One for the staying stakes, one for access. And suddenly, what looks sustainable becomes fragile. Think about your own life for a moment. Imagine your mortgage payment doubling overnight, or your credit card interest exploding, or your employer suddenly struggling to refinance its debt. That's not theoretical. That's how higher rates actually move through the economy. In 2008, the problem was leverage hidden inside the banking system. Today, leverage is everywhere. In governments, in corporations, in private markets, even in retirement systems. The risk isn't concentrated, it's distributed. and distributed risk is harder to see and harder to stop. I've seen this pattern before, and it never ends well. First, central banks tighten to fight inflation. Then something breaks. Then they're forced to choose between stability and credibility. And every time they choose stability, the long-term cost grows. Look at the numbers. Global debt is higher today than it was before the financial crisis. Much higher. And not just in absolute terms. Relative to economic output, the burden is heavier. That means less flexibility, less room for error. Now layer on demographics. Aging populations in developed countries. Fewer workers supporting more retirees. That puts pressure on growth, on tax systems, on pensions. And when growth slows while debt remains high, something has to give. The media talks about inflation as if it's a temporary inconvenience. But inflation is a symptom. The disease is imbalance. Too much debt, too much dependency on policy support. Too little real productivity growth. I've watched households quietly downgrade their lives. Same job, less savings. Same hours, more stress. People feel it, even if they can't articulate it. And that psychological pressure matters, because confidence is a pillar of the system. When confidence erodes, behavior changes. History gives us warnings if we're willing to look. The dot-com bubble taught us what happens when valuations detach from reality. The 2008 crisis taught us what happens when leverage meets complexity. Today's situation combines elements of both, with one key difference. The scale. Markets are larger, institutions are bigger, interconnections are deeper, and interventions are more expected. That last part is critical, because when everyone assumes someone will step in to save the system, risk-taking increases. Here's a shocking fact most people don't know. A significant portion of market liquidity today depends on confidence, not fundamentals. When confidence disappears, liquidity can vanish faster than models predict. I've seen it happen. Prices gap, assets freeze, and suddenly exits are smaller than entrances. I remember speaking with leaders during moments of stress, when decisions had to be made in hours, not weeks. The public imagines control. In reality, it's triage. And triage means not everyone is saved. This affects ordinary people in ways that don't show up immediately. Retirement accounts fluctuate, job security weakens, credit tightens, housing affordability shifts. These changes feel gradual until they aren't. Most people ask the wrong question. They ask, will there be a crash? That's the wrong frame. The right question is, how does the system adjust when pressure becomes unbearable? Sometimes that adjustment is violent. Sometimes it's slow and grinding. Both are painful. What worries me most is not volatility, it's false calm. Periods where everything looks stable while structural damage continues underneath. That's when people stop preparing. I've spoken to business owners who delayed decisions because things might get better. I've seen investors chase returns because they felt they had no choice. And I've watched families assume tomorrow would look like yesterday until it didn't. The severity of what's happening isn't just economic, it's psychological. Trust in institutions is eroding. Faith in long-term promises is weakening. And when trust disappears, systems strain. Let me be very clear, this is not about predicting doom. It's about recognizing stress. Stress that builds quietly and visibly until it expresses itself. The question isn't whether challenges are coming. The question is who understands them early and who waits for confirmation from headlines. Because by the time the headlines catch up, the opportunity to protect yourself has already narrowed. And now that you see what's happening on the surface, it's time to talk about what's happening behind the scenes. The conversations that never make it to television. The moves that don't show up until much later. That's where the real story is. Here's what they don't want you to know. The public narrative is designed to calm you, not to prepare you. Stability is a message. Preparation is a responsibility. And those two things are often in conflict. When I'm in private meetings, this is what we actually discuss. Not whether growth will be strong next quarter, but where the system is most fragile. Not what will go up, but what breaks first when pressure increases. Those conversations are quiet, serious, and very different from what you hear on television. Let me tell you something most people don't understand. Transparency disappears when stakes rise. Governments talk about confidence. Banks talk about strength. Institutions talk about resilience. Privately, they talk about contingency plans, liquidity backstops, emergency scenarios. I've sat in rooms where leaders openly admit they're navigating between bad options: raise rates and risk defaults, cut rates and fuel inflation, tighten spending and face unrest, spend more and worsen debt. There are no clean exits anymore, only trade-offs. Here's the hidden truth. Policymakers are reactive, not proactive. They move after stress appears, not before. And that means ordinary people are always behind the curve. By the time action is taken publicly, insiders have already repositioned. When the media says soft landing, insiders ask, who absorbs the shock? Because shocks don't disappear. They transfer from balance sheets to households, from institutions to individuals, from future promises to present pain. When I sit with wealthy families and large institutions, here's what they're not asking. They're not asking how to get rich quickly. They're asking how to avoid permanent loss. That mindset alone creates a massive gap between outcomes. The public is told to focus on returns. Insiders focus on durability. The public is told to stay calm. Insiders quietly stress test worst-case scenarios. That difference compounds over time. Another uncomfortable truth. Complexity protects those who understand it and punishes those who don't. Financial products, pension structures, policy language. It all becomes harder to decode during periods of stress. Confusion is not accidental. It slows reaction. I've watched crises unfold where the real damage happened before people even understood what was happening. Markets moved, credit tightened, jobs disappeared, and only afterward did explanations arrive. Here's a myth that needs to be shattered. That large institutions always know exactly what they're doing. They don't. But they do have one advantage: speed, access to information, and the ability to move capital quickly. Ordinary people don't get that luxury. Another myth, that governments will always step in to protect households. They try, but their first obligation is system stability. And when forced to choose, they protect the structure, not every participant inside it. I remember moments when decisions had to be made in days, not months. And those decisions had consequences that lasted decades. People assume there's time. There often isn't. Here's what's happening behind the scenes right now. Institutions are reducing exposure to fragility. They're reassessing assumptions that were once taken for granted. They're questioning correlations. They're planning for scenarios that used to be considered unlikely. That's not panic, that's preparation. And yet the public is encouraged to believe that concern equals negativity, that questioning equals pessimism, that preparation equals fear, that framing keeps people passive. Let me be very clear. Hope is not a strategy. Optimism without action is vulnerability. There's also a quiet shift happening that few people talk about. Trust is being replaced by contracts, relationships by rules, flexibility by rigidity. That happens late in cycles. When trust erodes, systems rely more on enforcement. That creates friction. Friction slows everything. When I hear people say, "This time is different," my concern increases. Because every cycle believes it's smarter than the last. And every cycle underestimates human behavior. Here's another hidden truth. Inequality isn't just a social issue. It's a financial risk. When too many people feel left behind, pressure builds. Political volatility rises. Policy becomes unpredictable. Markets hate unpredictability. And yet, the system continues to reward those closest to capital. Not because of conspiracy, but because proximity matters. Access matters. Information matters. Most people are not failing because they're lazy or unintelligent. They're failing because the rules changed, and no one explained the new ones clearly. What you're being told publicly is designed to keep the system functioning. What you need personally is designed to keep you functioning. Those are not the same thing. That's why this conversation matters. Because once you understand the difference between narrative and reality, between reassurance and preparation, you stop waiting for permission to act. And that brings us to a hard question. Why do most people still fail financially, even when warnings exist? Why do they stay exposed? Why do they repeat the same mistakes cycle after cycle? That's not an accident either. That's what we need to talk about next. Now, let's talk about the uncomfortable part, the reason most people will fail financially. Even after hearing everything I've just shared, this is where people usually get defensive. And I understand why. But if you can sit with this honestly, it might be the most valuable part of this entire conversation. Most people don't fail because of bad luck. They fail because of behavior. Let me tell you something most people don't understand. The biggest enemy of financial security is not the market. It's human psychology. Fear, comfort, denial, and the need to feel normal. I've been in this business for over 40 years, and I've watched the same mistakes repeat in every generation. People wait for certainty in a world that never offers it. They wait for confirmation from headlines, from friends, from experts on television, and by the time confirmation arrives, the opportunity is gone. Here's the first critical mistake. People confuse familiarity with safety. If something feels normal, they assume it's safe. If everyone around them is doing it, they assume it must be fine. But history is brutal on consensus thinking. The crowd is almost always late. Think about housing booms, stock manias, credit bubbles. They don't feel dangerous while you're inside them. They feel validating. Comfortable, everyone tells you you're smart for participating, until suddenly they don't. Another mistake. People outsource responsibility. They assume someone else is watching the system. The government, central banks, big institutions, employers, pension managers. But let me be very clear with you. No one cares about your financial future more than you do. And no one will step in fast enough if things go wrong. I've seen people stay fully exposed because markets always recover. That's true in aggregate, but not in individual timelines. Not everyone has the luxury of waiting 10 or 20 years to recover from a mistake. Timing matters when life is involved. Here's another hard truth. The middle class is trapped by habits that once worked, but no longer do. Save a little, spend a little more, carry some debt, assume stability. That formula worked in a different era. Lower debt, higher growth, stronger safety nets. Today, that same behavior creates fragility. People also underestimate slow damage. They look for crashes, not erosion. They ignore rising costs, shrinking purchasing power, and growing dependency on credit. But slow damage is often more destructive than sudden collapse because it's easier to ignore. I've watched people cling to assets they don't understand because they're afraid of missing out. I've watched them avoid hard conversations about spending, risk, and trade-offs because it's uncomfortable. And I've watched them confuse optimism with preparation. Here's the psychological trap. Doing nothing feels safer than doing something, especially when doing something means admitting the world has changed. Inaction feels neutral. It isn't. Inaction is a decision. The wealthy understand this instinctively. They don't wait to be forced. They adjust early, quietly, without drama, not because they're smarter, but because they've learned the cost of delay. Another reason most people fail. They chase returns instead of resilience. They ask, what can make me money? Instead of, what can protect me if I'm wrong? That single shift in thinking explains an enormous gap in outcomes. I've seen people stretch for yield because they felt pressured. Low interest rates made patience feel foolish. Risk felt necessary. And when conditions changed, they were exposed. There's also a cultural issue no one likes to talk about. We reward consumption more than discipline. We celebrate visible success, not quiet stability. That pressure pushes people into decisions they don't fully understand just to keep up. Let me be blunt. If you keep doing what everyone else is doing, you will end up where everyone else ends up. And for many people, that means working longer, stressing more, and feeling perpetually behind. This isn't about intelligence. Some of the smartest people I've met made terrible financial decisions because they ignored behavior. They assumed knowledge alone was enough. It isn't. What separates outcomes is not access to secret information. It's the willingness to act before action feels comfortable. If you're waiting for perfect clarity, you'll wait forever. If you're waiting for permission, it won't come. And if you're waiting for pain to force change, the cost will be higher than you expect. I'm not saying this to shame anyone. I'm saying it to wake you up. Because awareness without action changes nothing. The next part of this conversation is about solutions. Real ones, practical ones. Not hype, not shortcuts, but shifts in mindset and strategy that actually work across cycles. But before we go there, I want to say this clearly. This content is shared strictly for educational and informational purposes. It is not financial advice. I don't know your personal situation, your income, your risk tolerance, or your goals. Any decision you make should be your own, ideally with professional guidance. If this perspective challenged you, if it made you uncomfortable in a useful way, share it with someone who needs to hear it. These conversations matter more when they're shared. And if you want to keep hearing clear, grounded discussions about money, risk, and the future, support this channel, subscribe, and stay part of this conversation. Your engagement, your comments, your questions, they shape what comes next. Because the worst mistake now would be going back to sleep. And with that awareness in place, we can finally talk about what to do differently.